All right, so thank you everyone for coming. I appreciate taking the time to invest in yourself and learn how to own your dreams. Today, we're just going to go over some details to kind of highlight the benefits of home ownership. It's a question people have to ask themselves, why buy? So I'm Millie Kanata. I'm with Vanguard Properties. I've been in the industry for, I don't know, since 2001. I worked in lending, and then now I sell the real estate. I also was a housing counselor, so I have a strong background in finance. And I teamed up with my favorite, Jeannine.
I'm Jeannine Sheppard. I am a mortgage loan advisor for People's Home Equity. I have been in the business since 2005. I actually did the opposite flip-flop from Millie. I started out as a realtor, and now I'm in finance. And we're just going to learn a little bit today about how to buy a home and what it takes finance-wise and what the market looks like, and tax advice and credit repair.
Perfect. So we also want to introduce our guest speakers. I guess we're guests here, but we have Penny, Hillary, and Karen, and they're all CPAs. Penny is a partner. Karen is a tax manager also, and Hillary is the senior associate. Thank you. So they'll be here. They have a different part of the presentation that will kind of, this is the meat of the conversation, is they're going to really kind of take the guesswork out of the benefits of home ownership as far as taxes go. So I'm just going to stay on this side. So as it says, the fastest way to increase your cash flow is by reducing your taxes. So like I was mentioning, the missing component, I believe, when people look at buying a house is it seems like it's a lot more money that they're going to be paying out of pocket. And so one of the fastest ways to actually reduce your taxes may be by purchasing a home and using the deductions. And so we'll let Hillary take that conversation on. But Jeannine and I actually went to a Poor Dad, Rich Dad conference, and what their model is to help people learn about investing and things like that. And through opportunity, knowledge, and action, those are your ways to success. So you guys are taking the first step. This is an opportunity to learn if buying a house is right for you or not. And with the knowledge and take action, then from there you'll own your dreams. So and it may not be today, but we'll make it happen when it's ready. So in your booklets, this is a home buyer guide. Lots of great information in there. It goes over the flow of a transaction, different terms that are used. Great, use it as your Bible, read it in the middle of the night. But at the back end, you'll see there's a workbook for the road to home ownership, and there is a budget that will be helpful for you to kind of get an idea of what your expenses are. If you're trying to save, it will help you kind of figure out where you could cut down your discretionary expenses and help you to make this a goal. So the first way to attain your dreams is you have to make a plan. So within there is your way to get that going. If you want further information, I used to be a housing counselor with Consumer Credit Counseling Service San Francisco. They're now called Balance. They do offer first-time home buyer counseling, and there's different programs that may be available that they could also offer to you. So I'd recommend you talk with them, and they could help you learn. If you're looking in different areas, they do have like applications for below market properties if that's something you're interested in, or just kind of get you in gear as far as thinking of how to make this realistic.
And Millie, do you know, is there an income limit to use their services for free?
No, it's actually all free. It's a nonprofit, so all the information is just for you to have added education, and that's it. And then, so this, I'm curious, where do you guys see yourself in 65 or when you're 65 years old? Do you have an answer? What's your answer, David?
Retired.
Retired, okay. And so we have to have a plan in order to retire. The way that our system kind of is set up, if we work, we may not get to that plan at the age of 65. Statistically, 45% of 65-year-olds depend on their family. 28% depend on government. 22% still have to work. 4% are barely meeting their needs. And it's really the 1% that have secured financial freedom. So our goal here is to kind of help you learn what you could do to be part of this 1%.
Yeah, does anybody here have family that's going to help take care of them when they're 65?
Yeah. My kids are my retirement plan. I invest in them. But yeah.
We would be playing like mathematics games on here.
Yeah.
And I think we're going to be in really big trouble if that's actually the case.
Yeah, and I
be.
think those numbers are probably going to increase just with cost of living and everything else, you know, and unless we have great accountants to help us budget our retirement and figure out our next steps. So I'm a firm follower of Warren Buffett. I think he's genius. He knows when to cash out. He knows what to buy. So I often watch what he's doing. And his quote, "If you don't find a way to make money while you're asleep, you will work until you die." So the benefit with homeownership is it, as Hillary will explain, has a tax benefit, 1, and 2, you could use it to create income or cash flow. And if you, in the area that we live in, rents being as high as they are, there is possibility for you to grow into where you have more than one home. If you were to rent out another property and so forth. So I would encourage you to consider those lines, only because when looking at real estate versus stock market, I think it's less volatile. And you have more control over it. And you can live in it. So, isn't that great? You can't live in the stock market, but maybe on Wall Street. They might kick you off. But so it's important to protect your assets. Get out of the 40-40-40 plan. Does anybody know what that means, the 40-40-40? So you work 40 hours a week for 40 years, and then you retire on 40% of your income. So that isn't a sustainable plan. I think we should encourage each other to have lots more.
Especially if you're renting,
Yeah.
right? Because if you're living on 40% of the income that you're making today in 40 years and rents have gone up, if you hadn't had the opportunity to buy a home, you're going to be in pretty big trouble,
There's no
I
such
would
thing as
imagine.
living off of 40% of your income.
No.
Yeah.
Is that anything that like
That's why you'll
regular
see
people are doing?
multiple
Not regular
families in
retired
one
people.
home.
Yeah,
So-
that's why they're
Okay.
relying on their family.
Yeah. Or a lot of people are looking now to combine housing or buy multiple units so that they could share that
Family
expense, because
compounds.
it's just too
But
difficult.
scrambling at the end, right?
Yeah.
Instead of having a plan so that you know that you'll be okay when you get there.
So yeah, just build a solid plan. I think is the best thing. Secure a quality team. So here we are, your realtor, your lender, your CPAs, and honestly, the CPAs are your best friend. They're the ones that are going to look at your financials and be able to really identify if you have a benefit to buy a house. And then there's other people you want to speak with, insurance, attorneys, different things like protecting your assets. You might consider trust on the road, things like that. And develop an investor mindset. So we kind of lead this world as consumers, but if we change our mindset and look at everything as an investment, then you'll succeed. Build a strategy with your team, plan, pick a market, and know when to take action. So in some cases, it may not be the best time to buy right now. A lot of people want to also buy their dream home, the first house they buy. That may not be realistic. Sometimes if your rent is cheaper, you might benefit from buying an investment property and have somebody rent that out until you're ready to move into it. So it's just thinking outside the box of different strategies that will help you. And everything is an investment. So whenever you're a consumer, consider, how is this going to reward me? Is it just a Starbucks that I'm just going to be wasting? Or maybe I should take that $5 a day and put it away and buy a house with that. I was spending $280 at Starbucks at one point, and I realized it's a lot of money that I could be using otherwhere. So I don't go to Starbucks anymore. But with that road to homeownership budget, these things will help you kind of identify. Or using your bank statements. The banks have a great job at helping you to see where your expenses are going and categorizing those. So just getting an idea of where your spending is and your habits. Once you recognize that, then you could change them, just like anything. So, and for focus on your return on investment. And yes, you want to consider the fact that when you're utilizing savings through your bank, the way it all works out, at the end you're maybe getting like a 1% interest. And so the way our appreciation, or well, inflation, the inflation's exceeding what you're actually saving. So when you're looking at lucrative investments, real estate is a fine investment. And especially in this area, because we have a quality of life that people pay a premium for. In addition, we have lots of people that like different industries that benefit around here. And so just considering all angles will help you be not just a consumer, but an investor. And if we can, it's always great to identify below market value properties. Sometimes they're the less desirable. They'll sit on the market. People don't want to touch them because they don't want to do a little bit of work. If you are in a position where you feel you have the knowledge or people to help you do that, it could be a good opportunity to help you to build your wealth. And locate properties with immediate cash flow. So what that means is basically looking at a renter situation. So if I'm able to buy a property for X amount and get a renter in there who's going to cover my mortgage, then I talk with my accountant, figure out the deductions and how that all plays into it. You might automatically have a cash flow coming in.
And for our first-time home buyers, this is most likely going to be identifying a property and knowing in 2 years that you're probably going to want to hold that and rent it out and cash flow from it to buy your next home, your move-up home.
Yeah, so it's all strategy, and then there's different tax things that, again, our great team here is going to help explain, but the people that have established wealth, they understand the benefits of the taxes and that how those benefits will continue to allow them to establish wealth. And I think that's a big missing component, is we often are kind of seen as we're taxpayers, but there are ways that we can reduce that. And so I'm going to head it off to Jeannine, and here's your clicker.
Yeah. Oh, good. Let's see if I know how to do this. How do I go back on that?
Here,
Clicked it too much. Thank you. I'll let you click it.
I don't know how to go backwards.
Anyways, the first step really to home ownership, I mean, besides consulting with your CPA or a financial advisor, if you use one, would be to contact somebody like myself, a mortgage advisor. You know, you need to know how much you can afford and how much you want to afford before you even start looking at properties. In the past, well, during the real estate boom, it was much easier, I would say, to get a mortgage loan for any amount that you wanted. And nowadays, our guidelines are a little bit more stringent for a good reason, to keep everybody in their homes and to not lose them down the road. So when you call me, what we're going to talk about is, you know, what you do for a living, what your future goals are as far as home ownership, if you know that. We're going to talk about your credit. We're going to look at your credit, identify if there are any items on your credit that you need to work on fixing. And if there are items that I can't help you fix, then I will refer you out to a specialist so that you can prepare to buy your home and come up with a plan to make that work. And again, you're going to learn how the maximum amount you can afford and compare that really to what you want to afford, what you're comfortable paying monthly, so that we can determine, you know, what market you're in and what area you can afford to buy in, and then hook you up with the realtor that will help you find the right property. If you don't have a down payment saved, there are a few programs available now for down payment assistance. In the past, it's been pretty difficult to qualify for down payment assistance. You had to have fairly low income, and then you had to also qualify for the loan. Our in Sonoma County, you can make up to about $122,000, I think, this year, and still potentially qualify for down payment assistance. And there's even grant programs where you never have to pay that money back. There are some programs where you might have to have a lien on your property and pay it off when you sell the house or refinance down the road. But there are grants that disappear once you fund your loan. And again, you know, once we talk about come up with your game plan financially, how you're going to purchase the home, how you're going to afford to make the payments, you will then meet with Millie and start shopping for a home.
That's my favorite part. I'll just keep clicking it.
Okay. So the 5, is there going to be another one?
Yeah, just did that.
The 5 basic items that you need to get pre-approved, and everybody's situation is a little bit different. But we like to see 2 years of W-2s. If you are new out of college, or, you know, maybe you were at home for a while and just went back to work, that's not always going to be 100% the case. You know, we could, if you don't have 2 years of income or job history from the same job, that's not going to be an issue. we need to know what your assets are, bank statements, investment accounts, even your retirement, because there are options to pull money out of 401ks for down payment in some cases. Proof of credit. So I'm going to pull your credit report. I need your social security number and your date of birth. I'm going to run your credit report. I'm going to review it with you. And again, make sure we actually have programs that are lower than 620 credit score. But if I can help you get your credit up above 620, you're going to get the better loan. It can get really expensive if you're below that. And 740 is really considered the niche spot, the best credit to get the best rate and the best loan program. And again, as a side note, down payment assistance, you have to have a 640 credit score to qualify for that. And anyways, proof of income, again, the W-2s or tax returns, that's not 100%, you know, but for self-employment, absolutely have to have a 2-year history, or you at this point can't qualify for a loan. You have to have been self-employed for at least 2 years and filed taxes. And then, of course, we need to prove your identity with your driver's license or passport.
Pre-approved. We're pre-approved.
And then, yes, we're pre-approved. Okay. And here's just a little kind of a snapshot. I thought this was really cool because it shows you, obviously we're kind of down below this area as far as what the payment would be at different interest rates. And we're kind of like right in here today, interest rate wise. But you could see, you know, how much purchase power you can have now compared to, you know, if you wait till next year or the year after, when we're probably going to start seeing rates more like this. Estimated closing costs and prepaid items, those are going to vary depending on the loan program and stuff. But payment wise, I mean, look at how much, if interest rates go up 0.5% at a $400,000 loan, it's going to cost you $120 more a month for that same amount of money if you are considering waiting for some reason other than affordability. And there is actually, this is in the little packet for you guys to review. I'm not going to do that one.
All right. So,
did I go back again?
You're fine. Now we're going to go ahead and
I'm good with technology.
Go over the exciting stuff with the taxes, because that's really where.
Did you?
Got my gadgets all set up.
Yes.
Luna Park used to have some silent seconds. Do they have them anymore? Does anybody have them anymore?
I haven't seen any in our county recently. It's been a couple of years, I think, since the Roanoke Park one went away. Hopefully we'll see more of it. I know that once in a while I'll see things, like if you're a certain employee of a certain union or a county employee, but no, not for a long time. There is, right now, the grant program that I'm working with is the Golden State GSFA, and that is for basically all of California.
All right, great. So let's get into the tax impacts of homeownership. My name is Hillary Erbert. I'm CPA and Senior Associate, as we said earlier today. I've been with the firm for about 3.5 years, doing primarily tax work and a bit of audit work as well. All right, so the tax benefits of homeownership. There are a lot of benefits you can get from owning a home. The big one is that you get increased deductions on your tax return every year, such as property tax, mortgage interest, points, other deductions. We're going to go into all of these into greater detail on some later slides. We're also going to run through an example so you can see how the tax savings actually works. We're also going to talk about when you eventually sell your home, you may be able to exclude part of the gain on that sale. And we'll also talk about today some of the document retention requirements that the IRS, you have to have that in order to prove your deductions. All right, so when you buy a home, you're going to start paying more expenses. You'll have a mortgage, you'll have property taxes, and the great thing is that you will get to most likely deduct those on your tax return now. A lot of people, especially in this area, they will take the standard deduction on their tax return, but when you buy a home, you get the boost of the deductions, and then you can start to itemize. So that opens the door for all of these other expenses that you can now deduct. And one of the big ones is real estate taxes. So real estate taxes, those are deductible the calendar year in which you pay them. Property tax bills most often run on a fiscal year, something to be aware of. They run from July of one year through June of the next year. And so keep in mind what the dates on your payments are, and you're able to deduct whatever you actually pay within that calendar year. So real estate taxes are also deductible when you pay them at closing or in the settlement, or through impound or escrow when you're going through that buying process. And you can only deduct what you actually pay, so if you get any credits, refunds, or rebates, you wouldn't be able to deduct those amounts. So there are some tax planning opportunities with your property taxes. Because they run on a fiscal year, you have an opportunity to prepay your property taxes and boost your deductions in 1 year. So maybe if you're anticipating you're going to get a little bit higher income, maybe your job gave you a nice bonus, but you can help offset that by prepaying your real estate taxes, bringing that down.
How far in advance can you prepay in 1 year?
It probably just depends on when they give you the bill, you know, because since they run on the fiscal year, I think one payment's typically due in October, the other in February. So you can pay that February, you know, in December, the year before, and get that deduction. I don't know that you can go out farther than that because they haven't done that paperwork and given you that bill yet. So, you know, you have some opportunities there. All right, and then also keep in mind that this will not benefit people who are on AMT, which is alternative minimum tax. This typically only affects higher income taxpayers, and if you are in AMT, you probably know it. If it's something that concerns you, you can talk about it with your tax advisor. All right, so when you get your real estate tax bill, there's going to be a bunch of things on there. Most of them are deductible on your tax return, but some of them aren't. So some things to keep aware of are monthly or annual fees for water, garbage, or other utilities. If you took out a loan to install a solar system on your home, those payments through your property taxes wouldn't be deductible on your return. Homeowners association dues and any fees for local benefits that you get in your neighborhood, like roads, streets, sidewalks, that sort of thing. All right, so probably the biggest piece, the biggest deduction you get once you buy a home is your mortgage interest. So home mortgage interest that you can deduct is really any interest on a loan that's secured by your principal residence or a second residence. So these loans can include a mortgage to buy, build, or improve a home, a second mortgage, an equity line of credit, a home equity loan, and it can even be a loan from someone other than a bank. You know, let's say you want to borrow money from a parent or maybe a really wealthy, lucky friend. As long as that loan is secured by the principal residence or a second residence, you can deduct that interest on your tax return.
So like if the seller carries, they could deduct the interest from that seller carry loan kind of thing. Right, yeah. Right. Mm-hmm. Yep. All right, so similar to property tax, mortgage interest is deductible in the year in which the payments apply. The deductible portion includes any late payment charges, prepayment penalties, and points, which we will go into more detail on a later slide. So every year the bank will issue you a 1098, which is a tax form that will summarize the total mortgage interest that you paid. It may also include the property taxes you paid during the year. As of 2016, they now include your loan balance at the beginning of the year and the property address of which property is securing that loan. So it has a lot of useful information in order to complete your taxes. So your mortgage interest deduction could be limited, and it depends on the value of the loan. There's two types of loans that are considered here, acquisition debt and home equity debt. Acquisition debt is the loan you take out to initially make your first purchase to actually buy the home. And then home equity debt are any loans that you take out against the home, and you can use this for anything, to pay off credit card debt, to buy a car, to make improvements on your home. So we have these two different types of loans. And you're only able to deduct the mortgage interest on up to $1 million of acquisition debt or $100,000 of home equity debt. So for example, if you take out a mortgage that's $2 million, you would only be able to deduct half of that mortgage interest. And there is a nice little exception here. If you don't have a separate home equity debt loan, you are able to, and you do have a home loan that is above $1 million, you can combine those two amounts and deduct the mortgage interest on up to $1.1 million on that loan, even without the separate home equity. Brilliant. Mm-hmm. All right, so points. Points are basically interest paid in advance, and you can deduct them the year in which you made the original purchase. If you incur points in a refinance, you can deduct those over the life of the loan. They can also be called loan origination fees or loan discount, and they can be written off in full when you sell your home,
when you refinance with a new lender or when the loan is paid off. Points usually aren't as big of a deduction as property taxes and mortgage interest, but still something to be aware of. So now that you probably get to itemize your deductions instead of taking the standard deduction, you get access to all of these other great deductions that can go on your Schedule A. A lot of the big common ones are charitable contributions, the license fees on your DMV registration, other personal property taxes, so maybe if you have a boat or an RV, you can deduct those fees, any investment interest, and then there are a ton of other deductions that you may be able to get. A lot of them are subject to limitations. The limitation is based on how much income you make. So depending on how high your expenses are in these categories and how much income you have will determine whether or not you get a benefit from these. But they can include medical expenses, unreimbursed employee expenses, or miles. So if you pay for things out of pocket for your job, or if you drive off-site, those things may be deductible. Tax preparation fees and brokerage fees. All right, so now we're going to run through our example. We're going to look through this couple who is considering buying a home, renting versus buying. So in our example, John and Marcia Mello are a married couple with one child. They earn wages and interest and currently rent a 2-bedroom apartment. They both own a vehicle and make monthly contributions to their church, and they make a yearly contribution to the food bank. They're considering purchasing their first home.
Great family.
All right, so we have a summarized version of their tax return if they are renting. So they have total wages of $100,000 and interest income of $1,000. So their total adjusted gross income is $101,000. So currently they're taking the standard deduction at $12,600. If we look at their itemized deductions, how they are right now, they don't have enough to exceed the standard deduction. Their DMV fees are $200. They have income taxes of $4,000. This includes your state withholdings and your disability insurance paid to the state. And it can also include any state estimated taxes and other things if they apply to you. And then charitable contributions of $2,000. So their itemized deductions right now are only $6,200. So they get a better benefit taking the standard deduction. And then they also get personal exemptions. You get one per taxpayer for your spouse and then one for each child. So those deductions reduce their taxable income to $76,250. So their total federal tax owed is $10,605. All right, now we look at the California tax return. So their California adjusted gross income is the same as federal. They're going to take the standard deduction for California as well at $8,258, which reduces their California taxable income to $92,742. So they owe tax of about $3,631. They get exemption credits, which are similar to the personal exemptions on the federal side, which reduces their total California tax owed to $3,087. So altogether right now they're paying $13,692 in income taxes to federal and California. So now they decide to buy their first home. Congratulations to them. Let's see how much of a benefit they get on their tax return. So when we look at their itemized deductions, now they have mortgage interest and property tax. Their other deductions are the same, so that brings their total itemized deductions up to $33,200. So now we have a side-by-side comparison of renting versus homeowner. No change to the income. And now instead of taking the standard deduction, we're taking the itemized deduction at $33,200. Their personal exemptions have stayed the same. So that reduces their taxable income from $76,000 to $55,650, which reduces their federal tax owed to $7,420. So that equates to about $3,185 in savings per year, or about $265 per month, just on the federal side. All right, and now when we look at California, they also get to itemize their deductions for California. The one thing they have to take out in this case is the income taxes. California doesn't allow you to deduct the taxes you pay to California on your California return. It's the same on the federal side. So the total California itemized deductions are $29,200. All right, so when we look at the impact on their California return, California adjusted income is the same. We're taking the itemized deductions now, which decreases the California taxable income to $71,800. So the tax due on that is $2,188. Again, no change to the exemption credits. So the total California tax owed is $1,644. So on the California side, they're saving about $1,400 per year or $120 per month. And if you add California and federal tax savings together, that's about $4,628 per year or $386 per month. So it can be pretty significant savings. This is a hypothetical situation using estimates. We definitely advise you to reach out to your tax advisor so they can do a more tailored analysis to your situation. Your savings could be more or less depending on your income and your loan terms and all of that. So there are some steps you should take after purchasing a home because you will be able to decrease your withholdings on each of your paychecks so you get more home every month in your pocket. So you want to update your W-4 to increase your allowances. When you do that, it will automatically adjust your California withholdings, but it doesn't always adjust quite properly. So if you need to further increase or decrease your California withholdings, you could submit a DE-4 to California. And then you also need to make sure you keep receipts and other documentation in order to prove your deductions. So for example, for mortgage interest payments and property tax payments, you'll want to keep your bills. You want to keep the 1098, which has your mortgage interest on it. Keep a copy of the property tax, the check you write for your property taxes. And we also want to mention charitable contributions because the documentation requirements here are a little more strict for the IRS. So it's very important that you keep all of your receipts regardless of the amount of the donation. So every time you drop the sweater off at Goodwill, get a receipt for that and you can add that to your deductions. And if you make any one-time cash contributions of $250 or more, you actually have to obtain a letter from the charity that acknowledges that contribution. It's not enough to have a copy of your check or the credit card payment. You have to get a letter from the charity in that case. All right, so when you sell your home, you may be able to exclude up to $500,000 of the gain on that if you're married filing jointly, or you can exclude up to $250,000 if you file single. So for example, let's say you sell your home for about $750,000 and you originally purchased it for $500,000. Then maybe during the time you lived there you did some improvements. Maybe you put in a pool, you got granite countertops, put in hardwood flooring. So you get to deduct that cost when you sell your home. So you have a net gain on sale of $200,000. And if you're married filing joint, you don't have to claim any of that as income on your tax return. You get to exclude it all. And so this exclusion applies only to certain people, so you want to make sure you be able to take advantage of this by planning ahead. So you get to take this exclusion if you own your home and use it as your principal residence for 2 out of the past 5 years. So this 2-year period doesn't have to be consecutive. You can live in it for a year, 6 months, move somewhere else, rent out this home, then come back later. As long as you get the 2 years within that 5-year period, you will be eligible for this. And short or temporary absences are also counted as a period of residency. So if you go on vacation for 2 weeks or a month, you get to count that as part of your 2-year residency period, even if you rent out your home while you're gone. And the exclusion is also considered per taxpayer, not per home. So let's say you have 2 siblings and the 3 of you decide to buy a home together and you all own equal shares of that home. So when you sell the home and you split the gain equally between you, each taxpayer gets the $250,000 exclusion, assuming they all file as a single taxpayer. So it's not like each home is limited to a $500,000 limit. All right, so your tax savings awaits. I hope that this was helpful, and you are more than welcome to reach out to us with questions on anything we've discussed. Yeah, thank you. Good job. That's awesome.
Introduce her.
Okay. I'm Tasha Key. I'm with Key Solutions. I have been a credit specialist in education in your credit for 13 years now. And I've been working with Jeannine as well as been great friends with Jeannine for a long time. I have had so many successes over the 13 years. I'm really proud of myself for that. And you know, you look at your credit score, it can be anywhere from, you know, the low 5s to, you know, 600s, and you need some help, that's where you would call me. So, you know, we want to be in your credit score, you want to be at least, you know, the 740 mark. But if you're lower than that, it doesn't take much to get you there. It can take anywhere from 4 to 6 months to get you where you want to be in your credit score. 80% of credit reports contain errors. So that's why the law's in place, and that's how I'm able to utilize the system that helps you rebuild your credit. So not only am I helping you fix what's wrong with your credit, I'm helping you rebuild. So, you know, with secured credit cards or adding yourself to an authorized account can help you rebuild your credit and give you good credit history. Your credit history and activity is the main component to a credit score. And it's broken up into a pie chart, but the main component is your history and activity. So if you have a credit card and you're not using it, or maybe you're just paying a minimum payment on your credit card, you want to actually use it because that's giving you activity. You know, when you sit on a balance that you're paying on monthly, you're not creating that activity. So that's the most important thing, is to use your credit cards. I've, you know, been able to have a number of things removed, such as bankruptcies, tax liens, judgments, child support lates, student loan lates. That's a big question lately about how student loans are affected when you go through this process with me, because the debt is not necessarily forgiven when you work with me. So the actual remark to your credit report is what I focus on, and helping you reestablish your credit. So I want to make sure that, you know, you're using your credit cards and that we can get as many things off of your credit report as possible in that 6 months I'm working with you. There's really no guarantee to how TransUnion, Equifax, and Experian, or you know, the FICO system is going to calculate your score in the end. But the main thing that I focus on is the education that you're going to get with me, and focusing on, you know, keeping you going through a process to help you get those results. So with that being said, I can, you know, raise your score anywhere from 45 to 150 points. And if you just had at least 60-point increase in your score, that could save you $30,000 in your loan, and could possibly lower the terms of your loan. So, you know, I'm really big on education, really big on systems, and having, you know, everything be systematic so that it's an easy process for you, and that you're hopefully not waiting a ton of time.
Can you give an example of your most recent success, what the credit was showing, and what you were able to do for them?
Yes, I have a client that went from 640 to 745, and that was only in 45 days. Wow. So, and the last 3 clients that I've signed up has actually had at least a 100-point increase. So, and I can't say that's going to happen for everyone, but, you know, it's big as far as, you know, getting results in a short amount of time. But I usually want to, you know, work with you for at least 6 months before saying that you're going to be ready. Under promise, over deliver.
Ask a question. 2 questions. One, do you have to have 3 lines of credit in order to qualify for a loan? 2.
Yeah.
You want to have a mixture of credit to really maximize your credit score. Mm-hmm. So an auto loan, some type of installment loan, a credit card, and well, at least 2 credit cards and an installment loan. That would be make the most sense.
Get the best credit.
Mm-hmm.
FHA's requirement right now is you have to have 6-month history for two lines.
And if you don't have 2, can they use utilities, or no?
Authorized accounts.
Some people do alternative credit. It's complicated, but yeah.
And then on those credit lines, if you're at 30%, is that the benchmark? You want to stay at 30% of
Yes.
the credit limit?
Yes, or pay it off
Still.
completely.
Yeah. Okay.
And that doesn't hurt your credit. What hurts your credit is closing an account less than 2 years, or you know, closing an account with a balance. You know, that hurts your credit. Or paying on a collection hurts your credit. So to come into the days with the mortgage industry, they are running off the FICO system 8. So the FICO system 9 is coming into play, which actually they're not going to be counting you making a payment on a collection against you, because right now it updates the activity. So it updates a date to your credit report, which means it's going to report for another 7 years. So that's going to be in play in the next, I would say, year to 2 years. Most mortgage companies are going to be going to the FICO 9 system. And with FICO scores, every credit score is different, you know, because you go to a bank and you might get one score, and then you go to a mortgage company, you might get a different score. You might go to Credit Karma and get a different score, or you might go to freecreditreport.com and get a different score. They're all industry specific. So if you go to an auto dealership, they're going to have a different score for you because they're only pulling certain information from your credit report that calculates that score. So the difference between, I'd say, Credit Karma and a FICO score that you get from a mortgage company, I would say it's at least 20 to 30 points off.
Higher or lower? Like
Lower.
Credit Karma is lower?
Typically.
Is it
That's
best
good.
to go to your loan officer or mortgage first and then?
I mean, I would say look at your credit report every 6 months, because whether it's Credit Karma or any, either Experian.com, you just want to look at your credit report to make sure that there's no errors. And when you go to a mortgage company, you don't want to have to pull your credit over and over and over again. I mean, it doesn't count against you more than that one pull within 30 days. You have 30 days to pull your credit for it not to affect your score. But you just want to make sure that before pulling your credit and starting that application process that you want to take a look at your credit report.
Even if it's through Credit Karma, at least you're going to kind of know what kind of activities on your credit. The score isn't necessarily going to be accurate, but you can call and maybe have a conversation with me like, hey, this is what my score is, but it's showing I have this old collection, or something like that, and then we can address that before I pull the credit.
Is that the best to go to, Credit Karma? If you,
It's free.
I use it.
Yeah.
A lot of my clients use it, and Credit Karma is accurate in some ways, and they're inaccurate in others.
TransUnion puts it out, so it's just.
Oh, it is?
And
yeah,
Equifax.
And Equifax. So.
Mhm.
okay.
Just the two bureaus.
Mhm.
At least you know if somebody put a collection on your credit, or if there was some weird error that,
Or looking at the dates that they were closed, because you want to see that they've, aged at least. How long can you have
on a collection.
Yeah.
Depends on the loan type. VA doesn't want any collection
in the last 12
if it's
months?
collectively over, I think, $1,200 or something. You have to pay them.
Okay, so but with the amount of time that the account has been on the credit report, so can you say like maybe 12 or 24 months that
Just
it's
depends.
aged enough
all,
that,
yeah, there's not really a actual
Okay.
number on that.
because some lenders are saying that, they want to see something age at least 12 to 24 months before,
They won't account it.
yeah,
It's,
they won't
really
count
a
it.
dollar amount. It's a dollar amount of total collections is what most programs are interested in.
A lot of FHA, especially. So, with that being said, I can help you. Anyone that that has less than perfect credit, there's no shame in having less than perfect credit. It's really what you're going to do about moving forward. So, I'm the one you call. I give a free consultation, and I'm ready to help you in your needs.
Yay. Well, thank you.
Thank you.
Another great resource, if you guys aren't aware, is mint.com. It is also another way to kind of see where your expenses are being categorized and identify what's discretionary and what could be put into different buckets. There was a couple of calculators also online that you could use to kind of get an idea of your tax benefits and what you could adjust your.
I need to add a slide.
Yeah.
We can definitely provide that.
But we could, if you guys want a copy of the presentations on the sign-in sheet, you just make a note next to it and we'll forward it to you. And then you have all our contact information. We'll need to get your card, so they all have that too. In the booklet, really, that's just some fine late-night reading, but I do encourage you to actually read it because it's going to help answer a lot of questions when you start getting into the process. And of course, we're still at the first step, so if there's other things.
For anybody watching our video too, where can they email you to get a copy
Oh,
of the
yeah.
booklet?
So if you're watching us on video, you could email me at Millie, MILLI, at VanguardSonoma.com. And my phone number is 707-477-7839. And from here, basically, I'm sure we're all at different points in our life as far as what is the next step, but like I said, you have our contact information, and as you're ready, we can design independent sessions or appointments, work with whoever's needed to bring in to make sure that you have a well-rounded plan, and then you just begin to execute. But I just want to thank everybody that came and helped us today. I think it was brilliant. I'm so happy that you all made the time to be here too. And any questions?
I'm sorry, I have a lot.
We love them.
As far as your debt to income ratio, what's the guideline now? Is There's usually a
That's a great question. It depends on the program, but even with the conventional Fannie and Freddie, we can get up to 50% on approval now for debt to income ratios. It's much
Is
more
that
lenient.
combined with the debt for their expenses as well as housing?
Yeah, it just depends on the run. You know, there's not a hard stop, but up to 50%. And then if it's a government loan VA, there's not really a debt to income ratio. Necessarily, it just depends on if the system loves the file or
And
not.
if you do 100% financing, it's 80, is it an 80-20?
If you do what?
100% financing, can you get 100% financing?
We have VAs 100% financing right now. USDA, you can get 100% financing. The
And that's
USDA,
Yeah.
yeah.
And it's good to consider USDA, sorry to cut you off, because the river is considered
USDA is, yeah,
rural
it's
development.
very specific about income. It's very specific about you have to plug the property in each time. So you can't just say, hey, I'm going to buy a house in Santa
Russian
Rosa,
River.
you know, or whatever, and use this program. You have to look it up for each one. But I mean, it's a great program for those who could qualify. I do hear a rumor that there's some 100% programs coming up, like 99% is really what I heard. I can't tell you exactly when, but you know, if you get qualified for the grant program, technically you're getting 100% financing, because you get up to a 5% grant and use that. There's a Freddie Mac conventional program and FHA, so potentially you could do 100% financing.
What's the lowest amount of down without those programs? What are you looking at? 10% down?
3.
3.5.
3.5%?
3, well, yeah, 3 too. I have a 3%, 3.5 on FHA. You're going to have monthly mortgage insurance. I don't know that we addressed monthly mortgage insurance, and I did have a question if that's a tax deduction or not. I don't know anymore. They keep changing it, but
Do keep changing.
yeah. So maybe you
At
guys
this
can let us
time it
know
is,
if it
correct?
is.
I believe it is.
Yeah, I think it was last year. I think I took it, but
Typical is 20% down? Is that
No.
standard?
that's a paper. 20%. Yeah,
To
no.
avoid having to pay private mortgage insurance, you want to put 20% down. However, most people don't have the option to do that here. And so if you have a 3.5%, then they would charge a private mortgage insurance, which currently is still deductible. And from there, once you get your loan to value ratio below at 79.99, then you could have them remove the PMI.
On a conventional loan,
Yeah.
not on FHA.
Not on yeah, it's built in, lender paid. And that's where it's really brilliant, because everybody's tax situation is different. So I think it's wise to have a conversation with your CPA, have a conversation with your lender, and we all powwow together to make sure that you have the perfect plan, because there's things that we won't be able to identify as realtor and lender that the CPA will be able to explain to you. Some people take out mortgages just for a deduction.
Yeah,
So
it's really goal dependent. Everybody has different goals, I believe, and
Yeah.
it just needs to be put together in a plan, and then we just make it happen. So,
How many months reserves do you have to have in the bank? Nada?
not for owner occupied.
Hillary, with refinancing, costs, fees are deductible like on original?
closing costs.
The points.
Yeah.
Yeah. So when the points you get to deduct over the life of the loan on your return. So you get a little bit each year.
Oh.
Yeah. And
So
then, if you
It'll be
refinance-
divided over a
right.
period of 30 years.
Right.
Like if someone just refinanced last year and he paid 1 point on the loan, he doesn't get to just take that, we'll say it's $3,000 deduction for this year. He has to divide that
Yeah.
by 29 more years or 30 years.
Right.
Mhm.
Yeah, but if you're refinancing, if you had any points on your previous loan, you get to take the remainder of those in that year.
Perfect.
So you might get a
Interesting.
little boost when you refinance.
And this is why you have a CPA.
We're so
We can
happy.
tell you all the great things and what to do, but they'll look at your numbers and make sure that it really fits your situation. So everybody's different. But any other questions? All right. Well, you guys are wonderful. Thank you so much for taking the time again, and we're here if you need anything.
Thank you.
Thank you.
Thank you very much.